What is a leveraged buyout? A leveraged buyout is a financial transaction in which a company is purchased with a combination of equity and debt, in which the company's cash flow and/or assets is used as collateral to secure and repay the borrowed money. The debt portion is usually around 60 to 70%, while the remaining equity portion is usually 30 to 40%, typically funded by a financial sponsor, with a traditional holding period of 5 to 7 years and an exit by a strategic buyer, another financial sponsor, or IPO. A leveraged buyout transaction applies principles similar to buying a house. When you want to make a large transaction to buy a big house, you would put down some money as cash and take out a loan to cover the remaining amount. The leveraged buyout process is usually funded by a majority of debt, with two parties being involved that includes a buyer and the target company. In most cases, the buyer is a private equity fund or firm that invests a small amount of equity and uses debt leverage to fund the remainder of the transaction. The main emphasis should be that to meet the cost of the acquisition of another company is purchased through borrowed money in the form of bonds and/or loans. The private equity firm deploys debt in order to enhance its returns. The purpose of a revolving credit facility is to help fund a company's working capital needs. In most cases, a company, when it is in need of cash, will draw down the revolver up to the credit limit and will repay the revolver when excess cash is available. Bank debt financing is a type of financing that includes bank debt, which offers a lower interest rate compared to subordinated debt. Due to the lower interest rate, it has heavier covenants and limitations. Bank debt usually requires full payback over a 5 to 8 year period. Bank debt comes in two forms, which includes the term loan A, which has to be paid back period of 5 to 7 years, and term loan B, which has a payback period of 5 to 8 years with a large payment in the last year. Mezzanine debt financing is the type of debt that is in a hybrid form, which includes, in most cases, equity instruments in the form of warrants and/or options attached with it. It enhances the value of the subordinated debt and enables greater flexibility when dealing with specific bondholders. Subordinated debt financing is also called junk bonds. They are mostly sold to the public and they command the highest interest rates in order to compensate the holders of the instrument due to their increased risk exposure. Subordinated debt can be raised in the public bond market or the private institutional market with maturity of 8 to 10 years, with various types of repayment dates. Seller notes financing in a leveraged buyout transaction are another type of financing which can be used to finance a portion of the purchase price in a leveraged buyout. In most cases, seller notes allow a buyer to issue a type of permissive note to the seller, usually a baby boomer business owner, who agrees to repay the note over a fixed period of time. Due to being inexpensive and easily negotiable nature, seller notes are a more attractive financing compared to other forms of junior debt and bank financing. Equity capital is contributed through a private equity fund or another private equity firm. The fund pools its proliferation of capital, which they raise through various sources, which include pensions, endowments, insurance companies, and accredited investors. Carried interest in an LBO firm, when it comes to carried interest, profits are shared by the acquisitions made, usually from a fund. Profits in the fund are usually split between the general partner and the limited partners after the initial contributions to partners through the capital they committed. In most cases, the general partner's carried interest is approximately 20% of the profits remaining once all partner capital is returned. When it comes to management fees in an LBO firm, they charge a management fee associated with identifying, evaluating, and executing acquisitions by the fund. Management fees usually average 2% of committed capital, but will be in the range of 0.75% to 3%. Co-investment that occurs in the leveraged buyout firm occurs between executives and employees, where they in most cases co-invest along with the partnership, based on the terms of the investment being equal to those afforded to the partnership. Having a set criteria for LBO targets is crucial. Here are key characteristics of an LBO candidate target company. A target company will be in a slow growth and mature industry, strong and clean balance sheet with little to no debt outstanding, strong management team and potential cost-cutting measures, minimum working capital requirements, and strong steady cash flows. low future projected capital expenditure requirements, feasible exit strategy and options, strong competitive advantages and market positions. In a typical leveraged buyout transaction, the financial buyers evaluate various investment opportunities by analyzing their expected internal rate of return, also known as IRR, which is a measure based on returns on invested equity. The measure of internal rate of return represents the discount rate at which the net present value of cash flows equals zero. Historically, financial sponsors use a financial metric called a hurdle rate, which is a minimum required rate with an average excess of 15 to 20% that can reach a high of 30% under good economic circumstances. The success of a typical leveraged buyout investment used by financial sponsors is based on a financial metric called cash on cash. In most cases, LBO investments returns have a range of 2 to 5x cash on cash. When an LBO investment returns 2x cash on cash, the financial sponsor has doubled its money. The majority of returns in a leveraged buyout are influenced by delevering, which is paying down debt, operational improvement in the form of margin expansion and revenue growth, and buying low and selling high in the form of multiple expansion. Exit strategies in an LBO analysis usually on average of 3 to 7 years. Private equity firms will sell a target company investment through an exit strategy that helps financial buyers realize gains and returns on their specific investments. This exit strategy usually includes an outright sell of the company to another financial strategic buyer and/or financial sponsor, or by means of IPO.